total returns, volatility of returns, and max drawdowns. This month, we are digging deeper into the potential benefits of adding listed REITs to a private commercial real estate portfolio. While investors' unique objectives will ultimately dictate their ideal balance of listed REITs in a portfolio of private real estate, we think the benefits of blending listed REITs and private CRE may be underappreciated. Welcome to the Real Estate Reel from Cohen & Steers. First, listed REITs have meaningfully outperformed private real estate historically. In fact, listed REITs generated average net returns of 10.9% from 1998 to 2021 compared to 8.6% for private real estate, according to a CEM benchmarking study. While listed REITs are similar to externally managed direct strategies at 10.9%, they are superior to value-add and opportunistic strategies at 9.3% and core funds at 8.7%. There are a couple reasons for this, including lower fees, better appreciation returns given more efficient deployment of CapEx. As you can see in this chart, listed REITs have generally produced similar income returns net of fees to open-ended funds that own core commercial real estate, known as Odyssey funds, but they have much better appreciation returns over various periods of time. Bottom line, investors seeking to maximize total returns in core real estate may be well served to increase their allocations to listed REITs. At certain levels of listed allocations, portfolios blending private with listed real estate allocations may also reduce volatility and mitigate drawdown risk, which leads me to our second point. It is true that listed REITs have higher volatility of analyzed quarterly total returns than private CRE, but while it may seem counterintuitive at first glance, adding listed REITs to a private portfolio at certain levels has been shown to reduce volatility. Keep in mind that listed REITs and private real estate have lower correlations over short time frames. One typically zigs when the other one zags. This can be used to an investor's benefit. Consider that since 1990, the annual standard deviation of quarterly listed returns is 19.1% versus 6.1% for Odyssey funds. Over the prior 10 years, it's 17.2% for listed REITs versus 5.6% for private. This is because listed REITs are more correlated to the broader equity market over the near term, while private valuations are inherently smoother given the lagged nature of appraisals. However, as shown in this chart, listed REITs and private CRE have much higher correlations over the long term. This makes sense given they have similar underlying fundamentals. Some investors may consider the lower near-term volatility of private a feature rather than a bug. To reduce volatility even further, however, we think adding a listed REIT allocation to private CRE portfolios is appropriate. For instance, a 10% allocation listed within a private portfolio reduces annualized volatility of total returns to 5.3% over the prior 10 years compared to 5.6% mentioned previously for a portfolio of 100% private. The third data point I think is important is that listed REIT allocations in a private portfolio have been shown to limit drawdowns. To mitigate drawdown risk of a portfolio, we think a 30% allocation to listed REITs within a private portfolio is warranted. For example, since 2014, the max drawdown of a portfolio with a 30% listed allocation is 13.9% versus 19.9% for a 100% portfolio of private and 29.2% for a portfolio of 100% listed. We also note that the Sharpe ratio with 30% allocation is unchanged compared to a 100% private portfolio, as higher volatility is offset by higher returns. Again, this may seem counterintuitive since listed REITs have greater max drawdown risk than private CRE, but remember that listed REITs are a leading indicator to private in both downturns and recoveries. This is exactly what has occurred since the private CRE market peaked in 3Q22. Listed REITs have outperformed private CRE by more than 33 percentage points, as listed has generated cumulative total returns of 13.4% over the prior 7 quarters, while private CRE has declined nearly 20%. These are simplified examples, and these metrics could be improved even more through active management of listed REITs. But we believe it helps to illustrate that there is an illiquidity return discount in core private real estate, unlike other private assets that typically trade at a premium to their public peers. It also shows, we believe, that investors should embrace listed REITs as a diversification tool that can potentially meaningfully enhance results. This analysis holds true over longer time periods as well. Subscribe to the Real Estate Reel via the link on the screen and tune in next month to see what we are watching.